I get asked all the time, what's happening to HIMS, the stock? The stock is down almost 50% from all-time high. Just a few weeks ago, the stock was going up. You was making videos on the company. You like the stock for the long term. Now the stock is down 50%. What's happening to the company? And I'm going to talk about that. But before I do that, I just want to show you a very funny meme I found on the internet. And this is just a few weeks ago, back in February, when HIMS was trading at $72 per share. And this is some guy, he's telling himself, I'm an idiot. Why didn't I buy HIMS when it was trading at 40? But now HIMS is trading at $34 after it went down. And he's saying, lol, I'm not buying this shit. I'm not buying this trash company that's down 50% from all-time high. And this is the biggest challenge in investing, is not letting the price influence our decisions. Like, not much has changed with the fundamentals over the last few weeks, but it went from being one of the best stocks of all time to one of the worst stocks ever. I went from being one of the best stock pickers people believe I am because HIMS was going up. Now I'm the worst ever, even though I'm still up 5x on the company and the stock is still up, 37% year to date, while the Nasdaq is down 10%. So it's all about perspective, guys, and it's very hard to, ignore the chart and focus on the fundamentals. I've been in the stock from $7 per share. I have multiple 40, 50% kind of pullbacks, and I was just focused on the earnings, focused on the long-term potential. And as long as this is intact, there's no reason for me to sell the stock just because it went up. I could have done that at $10, $15. I didn't do that then, and I'm not doing it now. But HIMS, for people that don't know, is more of a telehealth company. They have sexual health, dermatology, hair loss, acne, mental health, and anxiety, depression. This is massive in the United States. 100 million people suffer from mental health, and 100 million people suffer from obesity, or you could say weight loss kind of problems. And the way HIMS platform work, it's not just a website that sells over-the-counter kind of prescriptions. They don't just sell hairsprays that you could find at the pharmacy. You get much more than that. One of the things you get is you get 24/7 support from a doctor. So if you have any questions, you can go on the HIMS app or the website. You can chat with a doctor about your side effects and all these kind of things. But they also have personalized subscriptions. And this is what people don't understand. As HIMS actually has labs, they have pharmacies where they modify certain dosage for you to fit your side effects needs. Because a lot of people, they have side effects from certain prescriptions or certain drugs. So HIMS would ask you, what are those side effects? They have doctors, they use AI, and then they modify the dosages within certain prescription for them to fit you personally. So they are making them custom made just for you to help reduce the side effects that you would normally experience with an over-the-counter drug. And this is something that's extremely important to understand with the company. They have a massive market share, over 47.5% market share, massive market share in telehealth amongst other kind of players. They are, of course, into weight loss. They do have the semaglutide, which got banned, and this is one of the reasons why the stock went down. It was labeled as a GLP-1 company. Now they took it off the shortage list, so HIMS will no longer be able to sell it as a commercially available dosage, just like it was. It would have to be personalized to certain people. They can't do that anymore, but it's still $165 per share. They have the oral-based solution, which is the underrated part of their business, where they have certain pills that help you lose 10 to 15 pounds in the first month or two. It's pretty powerful, and it's only $69 a month. It's much, much cheaper than, Ozempic and all these kind of things. And they also have liraglutide, which is coming up, they said, in late 2025. So it's going to be very interesting to see what happens with liraglutide. And for HIMS, based on what I'm seeing on the internet, they have really stopped selling those kind of dosages. So if you're not on a personalized plan, they told them, I'm sorry, we cannot give you those dosages anymore. You would either have to get on a personalized plan or find maybe the oral kind of weight loss kind of prescriptions from HIMS, or when they have the liraglutides, they can put them on liraglutide. And there's so many different prescriptions they can put them on, but they cannot give them those semaglutide kind of dosages, which I believe is good from the company, because I don't want the company getting sued for doing something outside the window. And they have, I believe, until April or May for them to be able to still sell them, and after that it's going to be over. So again, I'm happy the company is doing the right thing and they're not trying to get in trouble. But the stock went down a few days ago because NVO, which is an amazing company, I talked about it, they came came up with their own kind of low-cost, semaglutide shot, which is supposed to compete with HIMS and HERS and other kind of telehealth providers. And they brought it up for almost $500 a month. And the stock went down. But $500 a month is a lot. A lot of people cannot afford $500 a month just for them to lose weight. They just can't do that. And HIMS still has a very competitive offering within their oral-based solution of only $69 per month and 24/7 access to a doctor, a provider. And a lot of people love that stuff. And even $500 a month is going to be very hard to compete with HIMS and HERS Health. Their subscribers grew 172% year on year, massive, massive subscriber growth. Revenue grew 95% year on year, massive, massive revenue growth. And it's not slowing down anytime soon. Adjusted EBITDA is expanding. It was 6% margins the year prior. Now it's 12% margin. And over the long term, they talked about 20 to 30% EBITDA margin. The company is not focused on being as profitable as they can be. They're focused on growing, widening their moat, and just maintaining the business, investing in themselves. And this is what they should be doing at this early stage of the cycle. So this is why if you look sometimes at the PE or at the earnings, they don't look like Pepsi. They're not maximizing cash flow. They're reinvesting in research and development and marketing. They're reinvesting in themselves. And this is why if you look at PE and you skip the stock because it's too high, you have likely missed it since it was at $7 per share. But just because you have to look in the income statement and realize that the company is actually reinvesting in itself for the long term. In terms of their guidance, they have 56 to 63% revenue growth for 2025. This is massive, massive revenue growth for the company. Adjusted EBITDA, they didn't have any major surprise in expansion. It's still 12 to 13%, but 63% revenue growth is massive in terms of guidance. And it does include $725 million for weight loss in 2025. But as I said, it excludes all these kind of things from semaglutide because they can no longer sell it. So it's mostly a lot of the oral-based solutions, a lot of the potentially regulated that could come online. They have 56 to 63% growth. And you have to look at the track record of the company. They beat 8 times. They beat 8 times their own guidance and the analyst estimates, and they missed 0. Over the last 8 quarters, they beat 8 out of 8, and they haven't missed a single time, which give those numbers a much higher likelihood of being accurate or potentially being conservative, whereas the company does even more than $2.4 billion. So that's going to be very interesting. Now, if you look at the PE ratio, it's trading at 32 times forward earnings, and this is non-GAAP, which includes stock-based compensation. 32 times, it's back to its mean PE ratio. And in my opinion, it's not expensive at all. We look at the price to sales multiple. It's now only trading at 3 times sales. 3 times sales, growing 50-60% in sales is dirt cheap for a company like HIMS. But I'm going to give you 2 simple valuation models, and always confuse people whenever I do my 10-year outlook based on their market share out of how much in terms of telehealth could grow, and people get confused. So I'm trying to keep it simple. For the estimates, they have 57% based on the management guidance. Then the analysts have 17%. I don't believe the company is going from 57 to 17. I just don't believe that. But the analysts, they have 17, then 23, 22, 19. I believe those numbers are on the low end, and I believe the company in this telehealth sector, with all the potential TAMs they can expand to, they should at least be able to grow 20% a year for the next 10 years. This is my outlook for the company. Now, if they're able to grow the $2.3 billion over the next 10 years, 20% a year, and I believe this is highly, highly achievable for the company, they get to around a $14.3 billion revenue stream. Okay, and we can write it down to $14 billion. So if we take the $14 billion and we time it by a 3 times sales multiple, which is low for such companies, and we're going to assume no multiple expansion, so 3 times sales, this is a $42 billion stock. The stock right now is sitting at $7.5 billion. This is almost a 5x or 5.5x on the company over the next 10 years, which is an amazing upside on the stock. But even taking a shorter term kind of outlook, and if you look at the own guidance of the analyst, which I believe they're conservative, and assuming by 2029, which is around 5 years from now, they hit pretty close to $5 billion. Now we take $5 billion and we time it by 3 times sales, that would be around $15 billion. Now, $15 billion divided by the current market cap of $7.5 billion, this is 100% on the upside. So for me, on the low case scenario, I'm seeing 100% on the upside over the next 5 years from the current price of $34. Over the long term, I'm seeing a 4 to 5x. If they grow 20%, and they will likely grow much more than 20%, likely 25 to 30%, and the price to sales multiple could end up being 5 to 7 times instead of 3 times if they have much higher margins. So again, to me, it's a little bit, it's more conservative than a little bit, and I like the numbers. I believe HIMS right now is presenting a good opportunity. I haven't said that in a long time, and you guys have been asking me if I don't own HIMS, when should I get in? And I told you guys under $35 per share looks interesting, and I still believe under $35 per share the stock right now is looking very, very interesting. Now, that doesn't mean the stock can't go lower, and it doesn't mean, it can't go down another 20%. So you have to do your own research. If you like the stock, you buy any dollar cost average down. That's what I normally do. I start in a small position, and then if the stock goes down, I'm happy because I can buy more of it at a lower price, reduce my cost basis. So that's how I try to do it, and this way it helps you, be in control of your own emotions instead of letting the market dictate you. If the stock is up, you're happy, and if it goes down, you're upset. So if you start small, you can always add later, and that would make it easier in general, especially with a volatile stock like HIMS and HERS Health. But this is all I have to say, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.